I don't know if it's a recessionary signal, but it is a signal that there's a lot of weakness in the system. And if you look at all of the cyclical data, the ISM, manufacturing information, inflation expectation, it's all telling you there's a lot of weakness. So I'm a bit surprised that the market's behaving as well as it is. And you know, I've been pretty bullish the last several years. This is the most cautious I am. Not that I think the market's going to roll over, but I think that the upside is more limited until the data gets a little better.
What's your S&P target for the year end?
It's 30.25, which is about 3.5% from here. If I was more bullish, I'd be inclined to up the number since we're so close. But I don't think that that's the way it's going to play.
So you're not in the camp that says stimulus is good for this market. I mean, that's what the message is.
No.
Look, the German market jumped 2% on Draghi going even easier. And U.S. also seems to be clamoring for a cut.
No, Sarah, I mean, if you look at what the savings rate does when interest rates are low, people have to save more money because they can't afford to retire in this. It's not good for spending. It's a sign for corporate business managers that there's a weak underlying environment and they make less capital commitments. So I think pushing rates lower is not going to be the help that everybody thinks it will be. In the near term, maybe, but longer term, I don't think so.
David, what's your take on this, particularly ahead of the Fed decision?
So I think that clearly based on the fund manager survey, everybody's on one side of the boat at the current juncture. You know, I don't necessarily understand the thesis behind bad news being good news and a Fed cut providing further support for the market. I think what you're seeing right now is, yes, some of the survey data is looking soft, but the hard data hasn't really rolled over yet. So we have this combination of a Fed which is sending a more dovish signal at a time where the economy still looks like it's okay. I mean, something needs to give at the end of the day. You can't have this impossible trinity of resolution on trade and easy Fed and moderate economic growth. One of those things is going to have to fall by the wayside at some point.
Let's talk about the latest Bank of America Merrill Lynch fund manager survey, which says U.S. Treasuries are now, for the first time ever, the most crowded market trade. Tech, which usually holds first place, came in second. Mike, the point about U.S. Treasuries being crowded does come down to where, in part, to where yields are in Europe, and we've got another sign of that today.
Well, that's for sure. I mean, it also reflects how the markets have behaved leading up to this survey. So this is fund managers saying what they believe the most crowded trade is among their peers. And how do you know that? Well, look at what yields have done. Clearly, they feel as if the market has moved faster than they believe fundamentals would have had you think. And honestly, some of the other numbers say that, too. If you look at futures positioning and Treasury bonds and all the rest of it. And there's been lots of flows into fixed income funds as well. So, yes, it does seem clear that people are really kind of piling on this low yield trade. Doesn't mean it reverses in a violent way, but I do think that it's interesting that a risk off trade is the most crowded at the moment.
Well, I agree. I think if you see a headline like this, that the most crowded trade is Treasuries, David, you wouldn't expect the stock market to be 1% from a record high.
Right, exactly. And so I think, the issue for investors here isn't, are stocks and yields moving in the same direction. The issue is, you look at what's priced into cash fixed income markets in terms of Fed moves, and you have to ask yourself, do you really think you're going to get 2 Fed rate cuts between now and the end of the year? I mean, we're going to need to see more than 2 cuts in order for yields to continue to rally. That, to me, suggests that yields are going to need to move the other way. And frankly, I don't think people are positioned for that. I think that stocks can continue moving higher, but rates need to edge back up higher as well.
Jonathan, why do we see banks rally today, both in Europe and here in the U.S., when yields have slipped so much?
Listen, I think it may have done it today. You asked me whether I would buy into this trade going forward. I wouldn't. If yields continue to be soft like they are, banks are going to be under pressure in the U.S., overseas, and the stock market's going to have a hard time continuing this. So did the market get excited today that magically central banks are going to bail us out? And